Hello there. Welcome to lecture 8 of the day trading model. This lecture is about D ranges. Before you watch this lecture, there are first a few things that are obligated for you to know. You need to have a solid understanding of market maker models. Secondly, you need to understand the concept of external range liquidity to internal range liquidity and internal range liquidity towards external range liquidity. If you do not understand these concepts yet, I apologize, but you should go back in time and watch all the lectures about these topics in order to gain or to build a solid foundation before watching this lecture. Else, the order in which you are getting introduced to the concepts that I'm about to share with you will not be correct. Everything that I'm teaching within this mentorship is being shared within an order. And this order is the order in which I would highly suggest you to study. The table of contents for this lecture are as follows. First of all, we're going to take a look at defining ranges and their respective functions. Secondly, we're going to take a look at a simple method for defining ranges. Thirdly, we're going to take a look at an intermediate method for defining ranges. And finally, we're going to take a look at advanced methods for defining ranges. During this lecture, the whole goal is to basically give you an understanding of all of the different ways and methods that you can define a dealing range. This does not mean that I will give you these dealing ranges on a silver platter. This does not mean that I will spoon feed you. It just means that I will introduce you to certain theory and I will explain to you how you can investigate the different theories that I'm about to share with you. Because once you understand that there is not just one dealing range, but that there are multiple methods of defining a dealing range, you will understand why, for example, price does not retrace into a discount when bullish of your dealing range and it still expands. Shouldn't price retrace into a discount before it is allowed to expand? Yes, of course, that's our logic. However, it's because you did not utilize the proper dealing range within that scenario. So let us take a look at the first topic of today's lecture. First of all, we're going to take a look at defining ranges and their functions. During this lecture, I will be referring to this schematic many times. This does not mean that I will just utilize the same schematic all the time. It means that within that schematic, multiple things apply. Because if we understand that every single dealing range has a range high and a range low, we should also understand that every single range therefore has a middle point, 50%. This is what we call equilibrium. This is a crucial reference point within the current dealing range because it tells us whether or not price is likely to expand towards the opposite side of the range when price gets to that price level. Because first of all, we need to understand that the function of equilibrium is the following. The function of equilibrium is to show to us whether or not price is in a premium, meaning in the upper 50% of the range, or in a discount, in the lower 50% of the range. Within the lower 50% of the range, we would look for longs, and within the higher 50% of the range, we would look for sells. Around 50% of that range, price will seek to consolidate. It will seek to distort time. It will seek to go sideways. Why does that occur? It traps people into believing that the market is stuck, that it's not going to move, that it's not going to do anything. And what do we know? That always follows after consolidation, expansion. And therefore, we often see around 50% of any dealing range time distortion take place, consolidation. When we understand that within a discount of that current range, we look for longs, and within a premium of that current range, we look for shorts or sells, we can apply different methods for defining that range. And that's what I will teach you during this lecture. We're first going to take a look at a simple method for defining ranges. The most simple method for defining ranges is measuring the dealing range from the range low, from the absolute lowest price level to the absolute highest price level of this current price swing. Meaning that from this low right here, an expansion leg took place. Higher prices were delivered. Between this low and the ultimate high that forms here, we can measure premium to discount. We can measure the dealing range. Why? Because this was an impulse swing right here. This expansion occurred from this low, and this reversal or retracement that is originating from this price level right here is the range high. Meaning we're taking a look at the most explosive price legs, and the beginning of every single explosive price leg is our range low or high. However, within this overall range from low to high, there are multiple ranges that we can establish. Because within this expansion leg higher, within this movement higher, there are multiple retracements legs that takes place, followed by smaller expansions. Every single one of those legs where there's a retracement followed by an expansion followed by a retracement, we can apply premium to discount filters to those legs as well, because the theory of ranges is fractal, ranges forming one another. This is what we mean when we say that price is fractal. The reason why PD arrays form on every single time frame is not so much because of the fact that the algorithmic signature of a PD array forms on every single time frame, but it's more so because the ranges forming one another. Because the PD arrays show how price is referring to the current ranges, and that's the most important thing. If we take a look at the bearish example, we can see that price trades into a price level right here, and it then begins to turn around. It forms a swing high. This is our range high. The moment that price shows sign of forming a real low, meaning we begin to see signs of, for example, SMT, or for example, a key point of interest being reached, whatever. All of these signs that you could look for to confirm a potential fractal smart money reversal forming. Whenever you see that, you can draw your dealing range from the high that formed to the low that formed. Again, with emphasis on 50% of the dealing range, and you will see how price will look to react around that price level. Let us now take a look at an example. Here we can see that from this high right here, the market displaced lower. Why did it displace lower? Well, we took out significant buyer's liquidity above this high. We failed to continue higher. So instead, the market began to roll over. What we can then do is that we can measure premium to discount of this displacement leg. Meaning we measure from the high to the low that formed during the displacement leg. Market retraces into a premium and it then distributes lower. Premium being above 50% of this dealing range. What we can see here is the opposite. We can see that a low forms right here after purging significant sell-side liquidity that is not showcased on this chart, but a low forms right here within a point of interest. The market expands higher. What we can now do is that we can measure from this low to high the dealing range. Market retraces into equilibrium, into a discount of the dealing range, into this BC, and it then begins to expand higher. Simple application of this way of measuring dealing ranges. However, sometimes price doesn't retrace into EQ of this range before expanding. Why does this occur? Why doesn't price retrace into a premium right here after we have seen displacement lower and then continues lower? Why does it just trade higher, trade into the CB, and then goes lower? You already heard me say there, it trades into this CB. But I'm not going to refer to that CB when explaining this, because I'm simply teaching you about ranges during this lecture. The intermediate method for defining ranges. This method is the following. This method is from the change in the state of delivery to the high or low that formed after the expansion leg. Meaning, the change in the state of delivery takes place if bullish the moment that price crosses this down close candle's high right here, which also seems to line up with a bullish breaker. However, that is not always the case. There will be a sequence of down close candles right here that trade into the price level where we are anticipating a smart money reversal to form. Our point of interest, so to say. The moment that price trades above this sequence of down close candles, a change in the state of delivery has occurred. And specifically, by the way, the open of the first down close candle. When this occurs, we can anchor from the open of that first down close candle to every single swing high or short-term high that forms after that, and we can measure premium to discount. We can measure Dean ranges. Meaning, what we can do is that, for example, we can anchor from this open right here all the way to this high, and then we can see what the true Dean range is. The true Dean range being the range that IBDA will look to refer to. The reason why this is the case is because of the following. When price has a change in the state of delivery right here, the moment that this price level gets crossed, a new delivery program is on the way. Meaning that IBDA will seek to deliver in a certain sense. And therefore, there are reference points that are important for IBDA to be able to refer to. What reference points are important? Every single reference point that is available within that new range. That new range gets created the moment that price trades above the open of the down close candle. And therefore, from the open of this down close candle all the way to the range high that forms here at this price level, we can see how price will gravitate to every single key price level within that range. The most obvious one being, of course, 50% of that range. You might be wondering, how could this be useful? Well, if we know that a high is likely to form in this area, and we begin to see signs of that high forming, the moment that price begins to show those signs, we can look to short. What can we target? Equilibrium of that range, at least. What if we're bearish? What if we are seeing bearish delivery take place? Well, what we then see is quite the opposite. We see that price trades into a price level where we're anticipating a high to form, or smart money reversal. And the moment that price trades below the open of the up close candle, right here, that sets up this final run higher. It's important to note that I'm not referring to the down close candle here. I'm referring to the first up close candle that forms after the low forms here. The moment that price trades below the open of that up close candle, a change in the state of delivery has taken place, and we can anticipate sell side delivery to occur next. When we see the sell side delivery occur and the market reaches a price level where it could potentially form a low, where we could potentially see buy side delivery occur next, note this occurs also at the right time usually. When we see that and we see that low form, we can measure the Dean range from the open of this up close candle to the low that formed right here. You can see equilibrium, and that would be our first target. Now, I want you to take a good look at these charts. I want you to take a good look at what I'm showcasing to you here. Are you seeing how what I'm showing to you is a simple schematic of how price trades above or below external range liquidity and then draws towards internal range liquidity? If, for example, this expansion leg higher made price trade above an old high, above external range liquidity relative to the range from that high that formed somewhere right here to the low, price creates a new high, so it has taken out external range liquidity. What can it retrace towards now? Towards internal range liquidity, towards 50% of that new DN range. If, for example, price was bearish and we have seen price create a new low, meaning we have taken out a low that formed in this area right here. When it comes to in this area, I mean, by the way, in this price range, in this price area, meaning the old DN range was from this low or this low's area to this high. We then took out that low, meaning creating a lower low. So now the DN range has shifted from that high, or this highest price range, I should say, because we know that there are multiple methods to define that range, from that highest price range towards that low, meaning we have taken out external range liquidity, sell side liquidity, liquidity that was resting below that old range's low. What can we anticipate now? We can anticipate price to draw back towards internal range liquidity, and that is where that 50% price level equilibrium comes in handy. Let us now take a look at the schematic that was shared prior. Why does price not retrace into a premium of that DN range from this high to low? And as you can see, here you have your answer. The answer lays in the following. The open of this upclose candle right here was utilized to send price higher, meaning price opened up here, formed a low, and it then immediately repriced higher, taking out this buy side liquidity right here. We then rejected that high and we displaced below this candle's open. What is this candle? This candle is a bearish order block. We then see price distribute lower, displace lower. So what can we now utilize to define this price range? We can define this price range, this DN range, by taking the open of this upclose candle to the low of this candle, measure premium to discount. We see price retrace into equilibrium of that range, and there it goes. You might be wondering, why specifically this upclose candle? Why not an upclose candle that formed right here? It's because on the lower time frames, this upclose candle was a fractal smart money reversal. And we are now on a relatively higher time frame because you can see less candles. If you would go on a lower time frame, you would of course see multiple candles and you would see multiple upclose candles in a row, and then you would take the lowest. Here we can see another example. Why does price not retrace into a discount before continuing higher? Why does it simply retrace into here and then expand higher? It's because this is not the way to define real DN ranges. I'm going to give you a second to take a look at this chart, and then I want you to think about the following. Where should it be anchored to? Where should the low of the DN range be anchored to? Please pause it. The low of the DN range should be anchored to the open of this downclose candle. The reason why this downclose candle is so important is because this downclose candle was utilized to reprice lower into the price level where we were anticipating a smart money reversal to form, meaning the moment that price crossed the open of this downclose candle, a change in state of delivery occurred, buy program was confirmed, and now this is the DN range. From this candle's open to this candle's highest DN range, we measure premium to discount, and we can see that price retraces into equilibrium and it then expands higher into discount. I apologize for the colors of premium to discount now being switched over relative to the previous examples. My OCD can't handle that. We're now going to take a look at advanced methods for defining ranges. First of all, we're going to take a look at the previous cycle range. And secondly, we're going to take a look at ranges between crucial price levels. First of all, we're going to take a look at the previous cycle range. Note that I'm referring to the same schematic again, where there's a range low, where we have 100%, and a range high, where we have 0%. 50% of that range has been showcased again, because it's an important reference point. What we can see is that during the current time cycle, price trades below the previous cycle's low. The market doesn't find resistance there. Instead, it displaces above there. The previous cycle's low begins to act as support. This confirms a reversal being in. We then see price trade towards equilibrium of the previous cycle's range, 50% of that range. Market displaces above 50%, and we then begin to see the market draw towards the previous cycle's high. When does this occur? This occurs when a reversal scenario is in play, where we see a run on the sell side liquidity below the previous cycle's low, and we begin to see the market reverse and draw towards buy side liquidity next. That buy side liquidity rests above the previous cycle's high. What is the important reference point that confirms to us that price is likely to draw towards the opposite side of the range? That reference point is equilibrium. Remember, when price consolidates around equilibrium, but finally shows a willingness to displace through equilibrium, it's a confirmation to us that price is likely to draw towards the opposite side of the range now. If we take a look at the bearish example, it looks like the following. It looks like the market takes out the previous cycle's high. It fails to act as support on price, so the market trades below it. Then the previous cycle's high begins to act as resistance on price, and we begin to see the market roll over. Premium raise acting as resistance on price, sell side delivery occurs. Market consolidates around 50% of that range, and when it finally displaces through it, we can anticipate the previous cycle's low, which is a crucial reference point for sell side liquidity, to be attacked, to be drawn towards. Let us take a look at some chart examples. First of all, I want you to take a look at this chart example, and I want you to simply pause the video and just see and try to analyze what you can gain from the data that is available right in front of you. Pause the video right away, please, because you do not want to miss this opportunity to learn. Don't press on play until you have completely analyzed this data. I'm going to add 2 price levels to this chart. If you did not pause this video, you wasted this opportunity to learn. We're going to take a look at the 1 to 2:30 time cycle, meaning the 90-minute cycle of the PM session. Or I should say, the second 90-minute cycle of the PM session. I annotated the low and high of the first 90-minute cycle of the PM session. We know that during the second cycle, IBDA will refer to the high and low of that previous cycle. The moment that price opens up at 1 PM right here, and the market doesn't show a willingness to trade towards the previous cycle's high above this high, because it didn't have to anymore, enough buy side liquidity was already attacked, we can anticipate the market to draw towards the first cycle's low. However, what confirms this, you might be wondering? Think back to what I just outlined to you. Equilibrium, 50% of the previous cycle's range, is a crucial reference point. Here I have annotated 50% of that previous cycle. Meaning this fat red line showcases equilibrium of that first PM cycle. The market displaces through that with a CB. It shows a willingness to move lower. Market retraces into that. Time distortion takes place. meaning the market consolidates, and then it finally begins to roll over and it draws towards the first PM cycle's low. Now, what I want you to investigate is how price consolidated around this price level right here on the buy side of the curve, and that when the sell side of the curve took place, the same basically occurred. Time distortion around 50% of that price range. The market then displaced below the previous cycle's low, and note that when the market retraces, it doesn't retrace any higher than the high of that 1130 candle, which is the candle that formed the low of that first PM cycle. And what do we know? When price trades below PXL, PXL has to act as resistance on price for price to continue lower. The market then expands lower towards the third AM cycle's low, the full AM low, and note that that candle acts as resistance on price as well perfectly to send price lower even during the session. We're now going to take a look at the next example. Please pause your charts before I put my lipstick on. Again, if you do not pause your chart, you are wasting this opportunity to learn. So please pause it. For your info, we're going to take a look at the 11:30 to 1 time window. That means that you are going to have to look at 10 to 11:30 and see whether or not you can see any significant lipstick that can be applied there. What I've done here is that I've annotated the low and high of the 10 to 11:30 time window. As you can see, the market did not take out the low of that cycle during the 11:30 to 1 window. Why not? Because it already took out enough sell side liquidity during the morning session. The market swept this low, and the reason why this low was being swept was because the market opened up at 10 a.m. lower, giving away the idea that it would then immediately fall over. What does everyone do? They try to chase it, they go short, market expands higher. What's the function of that expansion leg higher? The market traps people into believing that higher prices are next. Where do they place their stop loss? Below this low. So the market sweeps that low, and we then see that low immediately get rejected. That signals to us that that sweep was a purge. The market then gradually but slowly and surely begins to reverse and begins to expand higher very slowly. We see discount arrays get created and the market begins to find support in those discount arrays. If we now put on more lipstick, we can see the following. We can see that equilibrium of that range is now annotated. Equilibrium being 50% of that previous cycle's range. What we see is that price displaces through equilibrium of that range right here with a BC, market distorts time, and it then begins to expand higher again. Displacement leg with a new BC, market retraces into equilibrium of the previous cycle's range, and it then has a beautiful buy program towards the previous cycle's high. Are you starting to see how equilibrium can be a very handy reference point when you're using time cycles? We're now going to take a look at the final way to measure dealing ranges. This way is by far the most advanced. It is by far the most difficult one to understand. However, I will try to simplify it for you. I will try to make it as easy as possible for you to understand. However, I must admit that everything that I will share during this part is limited. And the reason why it is limited is because I'm trying to protect myself and my loved ones. Because the consequences that it could have if I would go out here and share what I really know, then I am probably going to be at risk and at danger. So I'm going to work between boundaries that I believe to exist. So it means I basically decide this is what I want to teach and this is what I'm going to keep for myself and for my future children. And I hope that you respect that. I have already given you plenty of hints within the mentorship within the past 3 months. So it shouldn't be hard for you to figure out what is really going on. However, when you do figure out what is going on, there's one thing you need to consider, and that's the following. When you see how price really moves and at what times it moves, and you get to understand that, you will feel very weird. You might actually probably feel scared. And the reason why you probably feel scared is because you will question whether or not what you know is something you should be allowed to know. Because the moment that a system that has been in play for centuries comes at risk, the system will try to do something and will try to eliminate the threat. And that's why you need to shut up with everything that you know. You just need to lock in and just apply certain things. What repeats for you, make your money, get out. Simple as that. And this is not me basically saying, oh, look, I'm holding stuff back for you. Because, yeah, of course I am. There are certain things that I just won't discuss in this mentorship. And yeah, that's just something you got to deal with. The precision that the concepts that I did, however, already share with you is undeniable. It's very precise. And just know that there's always more to dig in, more to discover. And I've already warned you since the beginning of this mentorship that I would not spoon feed you. I would not be out here just putting a spoon in your mouth and saying, okay, look, this. No, I said I'm going to make this clear. I'm going to explain stuff very clear to you in an organized manner. However, that does not mean that I will just go out there and share everything with you like that, because there will have to be work from your side in order to develop and learn. So, anyhow, sorry for the rant. I tried to make this model series as objective as possible, as objective as possible when it comes to the theory that I'm sharing with you. However, sometimes it is important to share some insights here and there, because else what would be the fun in all of these lectures? You're probably already like, can he continue? Yes, I will continue. So ranges between crucial price levels. For this example, I'm just going to utilize the most simple price levels, the most simple dealing range. We have already understood the logic from a range low and a range high, and 50% of that range being equilibrium. Instead of now looking at past price action, we're going to look at price levels. You might be wondering, price levels? Why are you looking at price levels? How is it possible that algorithmic signatures are present when there is no past price action? Think about that question for a second. I'm going to leave it open for you to answer that question. If we take a look at the price levels, you can see that I've annotated a 0 and a 100. This is of course a very simplistic example, and we know that 50% is 50, of course. When we know that at a range low, we will look for a low to form, meaning we will look for a smart money reversal within a market maker buy model to form, we can look for signs to confirm that at the range low. What? What did you just say? I'm telling you, if some of you would go back to all of the lectures that have been shared so far, you would laugh your ass off, because every time that I speak about a point of interest, you hear me say specific price level. Yeah, I'm telling you, I don't even utilize higher time frame PD arrays. What? There's so much data available for you to utilize. And you just got to understand that the higher time frame PD array is simply a algorithmic signature of very specific things occurring. And if you want to go down into a very precise path where you're exactly trying to look for the SMR areas, then you would have to research what I'm sharing with you right now. However, if you're okay with saying, okay, well, price could tap into this price level and it could go a bit beyond it, because the POI, the point of interest, is this big, then sure, go ahead. Be content with that. But if you want to be very precise, this is how you do it. So you have a price level where you're looking for smart money reversal to occur from. Price taps that price level, smart money reversal within the market, make a buy model unfolds, and the market reverses and expands higher. Equilibrium, 50% of that range. We can anticipate time distortion and consolidation to take place. When price breaks through equilibrium, we can anticipate the opposite side of the range to be reached. Now, when the opposite side of the range gets reached, one or two things can occur. The market either reverses or retraces, or it continues through the price level, meaning it breaks above the price level. When it reverses or retraces, we of course see the signatures present that could, for example, showcase a market maker sell model fractal to you. However, what happens when price expands above the price level? What could we then anticipate? Well, here you're going to learn something that is completely unknown to 99.99% of everyone out there, of all traders, I must say. And it is something that many people can't even get their minds around. Because if we understand that ranges are fractal, how could a range be fractal? The only way for a range to be fractal if that range is being formed inside of a larger range. Okay, well, if we know that, then that larger range consists of multiple smaller ranges. So now some of you are already probably guessing and thinking, well, when price breaks above 100, what is the next range? Smart ones, the quick ones, have already thought of the following. Well, that zero that you're looking at, that could turn into 100. And what's the next range? 100 to 200. Okay. So if we now have a new range established, what will we be looking for? We will be looking for the market to retrace into the 100 price level, smart money reversal to originate from that price level, market maker buy model should occur. Equilibrium is where we can anticipate consolidation and time distortion. When price displaces through that price level, price is likely to draw towards the opposite side of the range. That right there is a gem. And I want you to investigate that, what I just shared with you. Taking a look at crucial price levels. And the easiest ones are simply, for example, the green price levels that are 100, 200, 300, 400, 500, etc. 1000, 2000, 3000. Let's say 10,000, 20,000. Let's say, for example, 100,000, 90,000, 80,000, etc. That's how you can calculate points of interest based on simply price. Again, like I said, there are different ways to utilize this information. However, this is the foundation, and there's way more that you can look into when it comes to this. And there's way more we will look into together as well during the upcoming months. However, this is something where not only me as your mentor, but also you have to be careful with, because there are limitations, there are people watching, and the moment you step outside of certain boundaries, funky shit can happen. Let's keep it that way. So let us take a look at some chart examples now. So for the chart examples, we will be looking at the ES chart. The reason why I've chosen ES is because it is a market with a relatively low value compared to, for example, Nasdaq or the Dow Jones, and therefore the calculations are rather easy to be made. So what we're going to do is that we're going to draw horizontal lines at every single 10 handles. A handle being, for example, from 43.50 to 43.51. And we're going to divide every single 10 handles into two parts. Meaning we're going to annotate equilibrium 50% of that price range as well. Equilibrium being showcased with the orange line. What we can see is at 8:30 we had some type of high impact news driver or medium impact news driver. Market opens up, distributes lower or manipulates lower, I should say, and it trades nearly into the 43.50 price level. Market forms a low there, and there it expands above the 43.55 price level. We then see the market continue to expand and it trades above the 43.60 price level. With what does it trade above that price level? With an imbalance. Now note that the market trades above that 8:30 high, time distortion takes place, the market consolidates, and it then begins to expand higher. Note that there's a BC that forms right here. The market consolidates again and it begins to expand. It trades above equilibrium of that new range at 43.65. Market consolidates, time distortion takes place. And then 9:30 comes along and the market begins to run higher aggressively, trading towards the 43.80 price level. What we can see is the following based on this chart. We can see that on a day where the market was programmed, engineered to expand higher during the morning session, or during this part of the morning session, I should say, every single key price level, when it comes to the calculation we just utilized, not saying that there aren't any different calculations, every single 10 handles is a crucial price level. So what is occurring is the following. When high frequency trading algorithms have detected that a low is in right here after 8:30, every single time that price crosses such a price, that's 10 handles above the inception, 43.50 right here. Every single time that price crosses, for example, 43.60 or 43.70 or 43.80, they buy. They just keep on spooling. They keep on buying. Why are they doing that? Because they know that the market is predetermined to expand, and therefore, every single time that the market shows to them that it is bullish, meaning that specific price levels are getting violated, they know that they can keep on buying it. And this is, of course, a way of breakout trading, and this is by no means efficient, because where a high frequency trading algorithm that trades like this buys on the breakout, we buy on the retracement into a discount array where the market is likely to form a low before continuing higher. And it's of course a way more efficient way of entering than just simply buying it on a breakout. But I want you to study how price reacts of these price levels. I want you to study how price moves between the levels, how it moves between range low, equilibrium, range high during this whole leg higher. And secondly, we're now going to take a look at the next example, where we see again that we've divided the ranges in 10 handles and equilibrium, of course. And what we can see is that from 9:30 on, we see manipulation lower occur, and then around 9:58, around 10, I should say, the market trades into the 42.65 equilibrium price level. Now notice that mean threshold of this bullish breaker forms exactly at 42.70. It's probably random. The market forms a low right there and it begins to expand above the 42.70 price level. Notice that the BC breaks through that price level. This moment on, a change in state of delivery has occurred. Why? Because the market traded above this high with this wick. We see the market trade above this CB, above this opcos candle, which is a bullish breaker. with a BC inside of that displacement leg, and the market is in a buy program. Now study how the market reacts off that 42.70 low. Smart money buys right here, or high frequency trading algorithms, I should say. Market displaces higher, above where? Above 42.75, which is equilibrium again of the range from 42.70 till 42.80. Notice that the BC breaks through that price level. Time distortion consolidation takes place exactly as anticipated. Why? That is what has been explained during this lecture. The market expands. Where does it stop? 42.80. Market retraces, goes back to that range high 42.80, gets stuck, trades above it, fails to utilize the support, comes all the way back into that BC that broke through that equilibrium price level initially, and it then begins a buy program. Why doesn't it continue higher here? Why were there high frequency trading algorithms that probably got stopped out on this run lower? They would have bought it right here the moment that price broke above it. Because the time wasn't right yet for the market to expand, more liquidity was required, and this is by no means clean delivery. I've chosen to basically showcase to you rather choppy delivery just to prove to you that the logic works and it repeats. What we see is that the market begins to expand, it draws towards the equilibrium of the next range, and look what occurs right here. This is perfect time distortion consolidation that takes place during the 11 to 12 window. This is not a preferred trading window at all, and this is why, because you can see this delivery take place. Notice that equal highs get engineered right before the 42.90 price level. I apologize for not having it annotated exactly there, but instead with a quarter above it. That's my bad. But what we see is that the market retraces into that small little inefficiency here that broke through equilibrium. Note that the market consolidated around that imbalance as well. Then trades higher. Look at this right here. Market goes above that price level and it begins to expand higher. Equilibrium of the next range is a crucial reference point. I could not have the whole delivery right here, what occurred here. So we just got to deal with this. We see that the market displaces below equilibrium of that next range with a CB. Market retraces into that CB and it begins to roll over and it draws back to discount levels, old ranges. By no means do I expect you to understand what I just showcased to you. By no means do I anticipate you to understand it right away, because this is a rather advanced way of looking at price, and this is something that not a lot of people utilize nor even know. So yeah, it's uh it's a fun way of looking at price because it removes the ambiguity why price does what it does, because this is all fractal. This even occurs within yearly cycles or monthly cycles. And are you noticing that what we're discussing here are price cycles? We have discussed time cycles, we have discussed AMD. However, we did not discuss how time cycles relate to price cycles, because there are time and price cycles. So that is something that you're being introduced to now. Before I end this lecture, I want to give you some homework. I want you to go into the charts and define the multiple ways of dealing ranges, from simple to intermediate and advanced. Note that you do not need to utilize all of them. Pick whatever you like. And the only way that you can decipher which one you like and which one you appreciate is by simply testing it out and seeing which one makes sense to you. What way of defining the ranges. Figure out which one suits you best, which one suits best your personality, and begin practicing with it. I want to thank you for watching this lecture of the model series. I hope that you found it insightful. I want to showcase you real examples during the next lecture. Meaning, I want to basically bring together all of the knowledge that has been shared so far. This means that we're now going to simply look at the charts and I'm going to share with you my experience when it comes to that, what I'm teaching you. Because I'm teaching you a way of looking at price, and specifically time and price, I should say, that is very uncommon, but it's very precise. And that's what you are seeing week in, week out. You are literally seeing the application of this model that I'm teaching you every single week. Now imagine if you would just capture one of those moves, one of those sweet go resistance liquidity runs. What would that do for you? Imagine that. That's exactly the feeling that you should hold close, and you should think about that every time when you feel like giving up, because eventually it will all be worth it. So I want to thank you for watching this lecture. I hope that you found it insightful, and I look forward to speaking to you in the next one. Be safe.